Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, October 13th, 2022. It is a bloody one indeed. So let's just hop right into it, talking about today's September CPI release out of the U.S. economy. So I think it requires an invocation of Coach Dennis Green's legendary rant, former head coach of the Arizona Cardinals. Core CPI is who we thought it was. So definitely go YouTube that if you're young and don't know that rant. But anyway, we've been talking about this for months now. CPI is proven itself to be sticky and stochastic, particularly on the core side. And we allocated a tremendous amount of resources in our October 22 macro scouting report last Wednesday to help our subscribers understand how resilient this U.S. economy, and we've been talking about this all summer, is how resilient this U.S. economy was and how that resiliency was likely to continue to perpetuate resilient core inflation momentum. And today's data bear that out. If you look at, headline CPI and core CPI on a month-over-month annualized rate of change basis, both accelerated to the fastest rates we saw since June. Headline at 4.6, core at 6.9. Core services CPI, which is the boogeyman in the room, obviously accelerated to a 3-month annualized rate of change of 6.7%. Not only is that moving in the wrong direction, we actually need to see the 3-month annualized rates of change get down to levels that are consistent with the Fed's mandate, as indicated by Powell and as presaged by yours truly months ago before Powell even said it. We need to get those things down to levels that are more consistent with the Fed's 2% inflation objective. I don't think we need to see a 2% 3-month SAR on core CPI and core PCE before the Fed pauses and tries to assess the damage according per its tightening regime. But I do think we're going to continue to see a march higher in terminal Fed funds rate expectations and a pushing out of the sort of pause as for every month that we kind of hang around this sort of 5 to 7 level. I think we got to break down into 3s and 4s for us to even entertain a sort of a Fed pause and no more positive revisions to the market's implied estimate of the terminal Fed funds rate. So we are still very much in phase 3, still very much in phase 5. For those of you who don't know what phase 3 and phase 5 are, I just realized we always have new folks. So let me just remind folks. So there's all these different phases of this monetary tightening regime. Phase 1 was the Fed catching up to the market. Phase 2 is the market pricing in the dovish pivot. Phase 3 is there will not be a dovish pivot anytime soon. Phase 4 was the fiscal response, which caused more phase 3. And now we're in phase 5, which is the market just has to accept the fact that there's not going to be any rate cuts or QE in 2023 unless we go into a hashtag actual recession, which has not been priced in. So we'll leave the rest of that for our subscribers on Lead Off Morning Note can understand what the implications of today's release are from a near-term and medium-term market perspective. So, as you know, all the actionable risk management takeaways from our research are behind the paywall. We try to share some of these insights outside of the paywall, particularly on the data side and on the catalyst side. But if you want to understand how to trade and profit from our research, you got to get behind the paywall. So anyway, shifting gears to my Longbow dashboard, which could easily be your Longbow dashboard. Running through global macro, dollars bullish, getting close to overbought here. So, in terms of, risk markets, the risk markets have been very inversely correlated to the dollar in recent months. So dollar gets overbought. You got to cover some shorts and take some shorts off, but we're not quite there yet. As you can see, we got about 1353 on the upside to the Bloomberg Dollar Index. A little bit of upside there. Bearish. Gold is still bearish in the middle of its range. 10-year Treasury yield bullish. Not quite as nearing overbought as the dollar, and that's an issue if you consider the fact that cross-asset correlation risk has been very much in favor of stocks and bonds going down together. S&P 500, that is bearish, not quite oversold here as well. So that's another one. Where's the lower boundary? So we're right around the lower boundary, the trading range here in the S&P this morning. So we're near oversold there. Bearish VAMs, NASDAQ, bearish Russell 2000. Get near there as well. Russell 2000 is outperforming the SPY and NASDAQ because it doesn't have the kind of duration sensitivity in the index constituents that the larger indices have. Let's see what else. Here we go. Bitcoin, Ethereum getting close to oversold. Obviously, both still bearish, not quite there yet. Shanghai Composite bearish, getting close to overbought, not quite there yet. Crude oil neutral, ag neutral, both in the middle of the ranges, and then industrial metals that's bearish in the middle of its respective range. And then shifting gears to my global macro dashboard. Got 300 ETFs in here, all representing individual factor exposures across every liquid asset class. sort it by, what's the most overbought to oversold. Nothing's overbought here this morning. So we're just going to scroll down and check out what's nearing oversold here. And the most oversold thing is Egypt and Chile. I don't think anybody here is long Egypt or short Egypt or Chile. We've got coffee there. Trying to find something that's particularly action or stuff that's people are really trafficking in. So Japan, we'll see FXY, the Japanese yen ETF, that is nearing oversold here. So if we start to see some the dollar fade, it's going to be driven likely by a move higher in the yen, a temporary move higher in the yen. And you got the BOJ obviously coming out and the threatening speculators with more intervention. Nat gas is been there. That's oversold here as well. So for those of you who are long or want to get long nat gas into this winter, that'd be a good opportunity there as well. And then a lot of the same signals that we saw in China. So not much going on this morning. I think, again, just to summarize, dollar's not quite overbought. 10-year treasury yield's not quite overbought. Bond yields aren't quite overbought. So as long as those things aren't overbought, you would not expect to see risk markets, materially rally until we see some fading in those particular key macro market indicators. So with that, Darius Dale presenting our macro minute for Thursday, October 13th. Everyone have a wonderful day out there and best of luck. I know it's a challenging year, but if you got the right research, you got the right indicators, you're probably doing just fine. Cheers.